The $100 trillion debt machine, leverage, power, and the quiet reckoning. There is now over $100 trillion in global public debt. Some estimates already place gross global public debt above $110 trillion in 2025. The United States alone carries approximately $38 to $39 trillion. Japan exceeds 230% of its entire economy in debt. Advanced economies average well above 100% debt to GDP. Emerging markets face rising refinancing pressure. Now here is what truly matters. A single percentage point increase in borrowing costs can translate into hundreds of billions in additional annual interest obligations for the United States alone. That is before pensions, before defense expansion, before the massive investments into artificial intelligence and semiconductor dominance. So the real question is this: if the world owes over $100 trillion, who actually controls the system? Because debt at this scale is not about repayment. It is about leverage. And leverage determines power. National debt is often framed as a warning sign, but here is the structural shift most people miss. National debt is not a failure of the system. It is the system. Sovereign bonds anchor pension funds. They serve as core collateral in global banking. They determine benchmark interest rates. They stabilize reserve currencies. In the United States, most of the debt is held domestically. Retirement funds, insurance companies, commercial banks, the Federal Reserve, foreign governments such as Japan, China, and the United Kingdom hold a portion. But the majority exists inside a domestic financial loop. This is not simply America owes China. It is a global architecture of trust. Consider how corporations operate. Apple carries debt even while holding vast cash reserves. Why? Because debt is structured leverage. It allows expansion without liquidating strategic assets. Governments function under a similar logic. Debt finances infrastructure, military capability, industrial policy, and technological advancement. But leverage amplifies pressure when conditions change, and that is where sovereign debt becomes strategic. Globally, public debt to GDP has surpassed 94 to 95% on average. Advanced economies exceed 110%. The last time debt levels were this elevated relative to output was during World War II. But after the war, demographics were favorable. Young populations, expanding labor forces, rapid productivity gains, industrial acceleration. Today, the dynamic is reversed. Aging societies, slower structural growth, rising entitlement spending. The world is operating at wartime debt levels, without wartime growth dynamics. And unlike after World War II, there is no demographic boom waiting to absorb the shock. That significantly narrows the margin for error. The United States maintains dominance not because it has less debt. It dominates because the world still trusts its debt. More than half of global foreign exchange reserves remain dollar-denominated. Oil trades in dollars. Global contracts settle in dollars. U.S. Treasuries function as the primary safe collateral in international markets. As long as demand for dollar-denominated assets remains strong, the United States can refinance at scale. That is leverage. That is control. But this is where the stress test begins. China has steadily reduced its holdings of U.S. Treasuries over the past decade. It is expanding yuan-based trade agreements, increasing gold reserves, developing alternative cross-border payment systems. BRICS nations continue exploring alternative settlement frameworks. None of this displaces the dollar overnight, but it introduces diversification, and sovereign debt systems depend on sustained demand. If global appetite for U.S. Treasuries erodes gradually, not collapse, just persistent reduction, borrowing costs rise. When borrowing costs rise, the pressure compounds. Now consider a realistic scenario. What if foreign demand for U.S. debt declines steadily over several years? Interest rates edge higher. Debt servicing costs swell. Budget flexibility narrows. According to the latest Congressional Budget Office projections, net interest payments are already exceeding $1 trillion annually. Within a decade, that figure could approach or exceed $2 trillion. At that point, interest would consume more of the federal budget than national defense. Policymakers would face constrained choices: raise taxes, cut entitlement spending, allow inflation to erode real debt, or expand borrowing further. Debt crises rarely begin with dramatic numbers. They begin when markets decide the risk premium has changed. Confidence shifts, yields rise, refinancing becomes more expensive, and stress compounds. Now add another layer: artificial intelligence, semiconductor subsidies, advanced manufacturing reshoring, defense modernization, digital infrastructure expansion. All of it is being financed within the same borrowing framework. The future is being leveraged. Debt is funding the AI race. Leverage accelerates growth, but it reduces tolerance for miscalculation. The higher the leverage, the smaller the margin for policy error. So who controls the $100 trillion debt machine? No single nation owns it outright. Control belongs to whoever maintains global confidence, anchors reserve currency demand, provides trusted collateral, stabilizes liquidity during stress. Right now, that structure remains centered around the United States. But dominance is conditional. It depends on growth, on geopolitical stability, on fiscal credibility, on market confidence. The debt machine does not explode loudly. It tightens quietly. Interest costs rise. Confidence recalibrates. Policy flexibility narrows. Power shifts rarely announce themselves. They evolve gradually. Then suddenly, the real question is not whether the debt machine exists. It is who adapts first when its direction changes. Digital Capitalist examines the structural forces shaping money, leverage, and global power. Because in an era where debt finances the future, understanding the system is no longer optional. Who adapts first?